Two men, same age, same salary. $55,000 a year. Same $50,000 sitting in a savings account in 2026. Same goal. Get rich. They never speak again for 20 years. Jake takes his $50,000 and puts it down on a $250,000 rental house. 20% down. Tenant moves in. Mortgage starts. He calls himself an investor. Marcus takes his $50,000 and buys an index fund. He never logs in again for the rest of the decade. He calls himself lazy. 20 years pass. One of them is sitting on $357,000 in equity. The other is sitting on $409,000 in cash. And the gap between them is not what you think it is, because one of them forgot to count the hours, and the other forgot to count the zeros. Before we go any further, a fairness rule. If I only show you the downsides of real estate, I am doing what every stock market guy on the internet does. If I only show you the downsides of stocks, I am doing what every real estate guru on the internet does. So we are going to do the math both ways. Honest numbers on both sides. Same starting capital. Same starting income. Same 20-year clock. By the end of this video, you will know exactly what each path actually costs. Not what it costs in dollars. What it costs in everything else. Let us start with the baseline numbers. The ones almost nobody bothers to actually pull up. Over the last 20 years, the broad US stock index returned an average of 10.8% per year, with dividends reinvested. Adjusted for inflation, the real return averages somewhere between 6.5% and 7% over a 100-year window. That is the engine. That is what Marcus is buying. Real estate is a different animal. The National Home Price Index, going back over a century, averages about 3.9% of nominal appreciation per year. Adjusted for inflation, that drops to roughly 1 to 1.5%. On an unleveraged basis, a house barely beats the cost of living. It is a savings account that needs a new roof. Stocks at 10.8. Houses at 3.9. If those were the only numbers that mattered, this video would be 90 seconds long. Marcus wins. Done. Roll credits. But they are not the only numbers that mattered. Because Jake is not buying the house with cash. Jake is buying the house with someone else's money. Here is what real estate guys mean when they say leverage. Marcus puts $50,000 into the index fund. The market goes up 3%. Marcus made $1,500. Clean. Honest. Jake puts $50,000 down on a $250,000 house. The bank lends him the other $200,000. The house goes up 3%. Jake did not make 3% on $50,000. Jake made 3% on $250,000. That is $7,500. On a $50,000 bet. 15% in a single year. And he can do it again. With a federally backed loan, a buyer with decent credit can put down as little as 3.5% on a small multifamily in 2026. $8,750 controls a $250,000 duplex. A 3% appreciation year on that property is an 85% return on the cash he put in. 85% on a boring 3% gain. This is the part real estate evangelists are not lying about. The leverage math is real. It is the closest thing the US tax code offers to a legal cheat code. Every billionaire who built their fortune in real estate built it on this exact mechanism. Other people's money, compounding on an asset they do not have to fully own to fully profit from. If we stop the video right here, Jake wins. He wins by a lot. But there is a second number Jake is not telling you about. Watch what happens to his beautiful 15% return when we add real numbers to it. The house rents for $1,800 a month. The mortgage at 6.5% on $200,000 is roughly $1,330 a month. So Jake is making $470 a month, right? $5,640 a year of pure passive income, right? Wrong. Property tax. Gone. Insurance. Gone. And in 2026, the average premium just jumped 12% and is climbing again. Vacancy. The national rental vacancy rate is 7.3%, which means 26 days a year that property sits empty. Maintenance and capital expenditures. The industry standard says reserve 1 to 2% of the property value every single year. The roof has a lifespan. The water heater has a lifespan. The HVAC has a lifespan. Replace the HVAC and there goes $12,000 in a single afternoon. Property management. If Jake does not want to be the one driving over to unclog the toilet at midnight, that is another 10% off the top. And then there is the tenant from hell, the one who stops paying, the one Jake has to evict. In 2026, the average eviction costs a landlord between $3,500 and $10,000 by the time you add up the legal fees, the lost rent, and the move-out damage. Seasoned landlords have a name for what is left after all of that. They call it the 50% rule. It says that on average, across enough properties and enough years, operating expenses eat half of your gross rent before the mortgage even gets paid. Half. Run that math on Jake's house. $1,800 in rent. $900 eaten by operating expenses. $900 left for the mortgage. The mortgage is $1,330. Jake is not making $470 a month. Jake is losing $430 a month out of his $55,000 salary. He is not running a passive income machine. He is running a slow leak, and he will keep running it for somewhere between 5 and 10 years because rent compounds at 2.5% a year while his mortgage stays fixed. Eventually, the lines cross. Eventually, the property does cash flow. But there is an eventually built into that sentence that nobody told him about when he signed the papers. Now Marcus. While Jake is signing closing documents, Marcus is hitting buy on a low-cost index fund. Expense ratio of 0.03%. He pays Wall Street roughly $3 a year on every $10,000 he holds. There is no roof. There is no tenant. There is no plumber. There is just one button, and he already pressed it. His $50,000 sits there. Year 1, the market does 8%. He has $54,000. Year 5, roughly $73,000. Year 10, $108,000. Year 15, $158,000. Year 20, $233,000. And remember, Jake has been bleeding $3,000 to $5,000 a year out of his salary to keep his rental afloat. To make this a fair fight, Marcus throws $300 a month into the same index fund. The cost Jake is paying to be a landlord, Marcus is paying to a robot. Fast forward 20 years. The $50,000 lump sum grew to $233,000. The $300 a month contributions grew to roughly $176,000. Total, $409,000. Liquid. He can sell any one share, any one Tuesday, in 7 seconds for $0 in commissions. He has not painted a wall. He has not screened a tenant. He has not heard the words water heater in 20 years. And here's the part the real estate gurus desperately do not want you to look up. Last year, 2025, 79% of professional Wall Street fund managers, the guys with Ivy League degrees and Bloomberg terminals, failed to beat that boring index fund Marcus bought and forgot about. Marcus did not need to be smart. He needed to be still. So let us run the 20-year scorecard, both men, side by side. Honest numbers. Jake's house, after 20 years of 3% appreciation, is worth roughly $451,000. The mortgage balance has dropped from $200,000 to about $94,000 because the tenant has been paying it down for 2 decades. Jake's equity, what he actually owns of that house, is $357,000. Marcus's account is $409,000. Marcus wins by $52,000 after 20 years of doing absolutely nothing. But hold on, look at the trajectory. For the first 10 years of this race, Jake is way ahead. Leverage is ferocious in the early years. By year 5, Jake has more equity on paper than Marcus has in his account. The lines do not cross until somewhere around year 15 or 16. Compounding is boring for the first 5 years and astonishing for the next 15. If you stop the clock too early, real estate looks unbeatable. If you let it run long enough, the index fund quietly walks past it. Most people stop the clock too early. Now run the same scenario again. But this time, in year 2, the economy breaks. Pick your decade. 2008, 2020, 2022. They all rhyme. Marcus's index fund drops 33% in a month. It is psychologically brutal. He stares at the screen for one bad evening. Then he goes back to his life. He owns no debt against the position. There is no margin call. Within a few years, the market recovers. He never sold. Compounding resumes. Jake's house drops 20%. The house is now worth $200,000. He owes the bank $196,000. His $50,000 down payment, that whole life savings he had, is worth $4,000 on paper. He is, in real terms, wiped out. And then his tenant loses their job, stops paying, will not leave. The eviction takes 90 days and costs him $7,000. During those 90 days, Jake, on his $55,000 salary, has to pay the mortgage, the property tax, and the insurance out of his own pocket every month, with no income coming in from the asset. This is exactly how thousands of over-leveraged landlords went bankrupt in 2008. Leverage is a magnifier. It magnifies the wins and it magnifies the wipeouts. The real estate guys on the internet only ever talk about the first half of that sentence. Marcus saw a number on a screen go down. Jake saw a bank send him a letter. Now here is the math the real estate gurus on the internet absolutely refuse to do. The math on the hours. Industry data on self-managing landlords says the average single rental property eats between 8 and 12 hours per month of the owner's time. Maintenance coordination. Tenant questions. Lease renewals. The text message at 9:47 on a Sunday night that begins with the words, "Hey, sorry to bother you." The phone calls that start, so the dishwasher is making this sound. 8 to 12 hours a month. Call it 10. 10 hours a month is 120 hours a year. Over 20 years, that is 2,400 hours of Jake's life. 2,400 hours. That is more than a full year of 40-hour work weeks, spent on a single rental property, that his accountant calls passive income. On the tax return, with a straight face, if we value Jake's time at $50 an hour, and that is conservative, that is roughly what his salary works out to, the implicit labor cost of that property over 20 years is $120,000. Subtract that from his $357,000 in equity. His real wealth, the wealth he actually built, is closer to $237,000. Marcus's number stays at $409,000 because Marcus did zero work. If you are not factoring in the 2,400 hours of labor it takes to manage a rental property over 20 years, you are not an investor. You bought yourself a second job. Now I owe Jake a Steelman. Here are 3 things his strategy quietly does that the index fund cannot do. 1. Forced savings. Every month, the tenant pays down a piece of Jake's mortgage. Jake did not choose to save that money. The tenant turned Jake into a saver against his will. For people who cannot trust themselves to leave money in a brokerage account, real estate is a bank vault you cannot log into and panic sell. 2. The tax code. Depreciation lets Jake deduct phantom losses against his rental income, sheltering his cash flow from taxes for decades. The 1031 exchange lets him roll the gains from one property into a bigger one without paying capital gains. And if he holds the property until he dies, his heirs inherit it at a stepped-up basis, erasing every dollar of gain in a single legal stroke. 3. Leverage on inflation. When prices rise, Jake's rent goes up. His mortgage payment does not. He is paying back yesterday's debt with tomorrow's dollars. Inflation, which is poison to almost every financial asset, is a gift to a leveraged landlord with a 30-year fixed rate. These are real advantages. They are the reason real estate has built more millionaires than any other asset class in American history. Jake is not crazy for picking the path he picked. But here's the reframe. The real trap is not real estate versus stocks. The real trap is that almost everyone treats this as a religion instead of a math problem. The real estate guys mock index funds because they like the feeling of touching a thing. The index fund guys mock real estate because they like the feeling of being too smart for it. Both sides are wrong about the other one. Jake worked for his money. Marcus waited for his. Neither of those is a moral failing. They are just two different deals with two different prices. And the prices are not just denominated in dollars. Jake's price is hours. Marcus's price is patience. And the truly wealthy people in this country, the ones with 8 figures, the ones whose names you will never hear, almost never pick a side. They use a federally backed loan to house hack their living expenses down to nearly zero. They take the salary they save and they fire hose it into an index fund. Real estate pays for the life. Index funds pay for the future. Real wealth whispers. Fake wealth screams. And the screamers on both sides of this argument are usually selling you a course. So here is the honest answer to the question this video is named after. Over 20 years, with the assumptions we used, the index fund wins. 409,000 to 357,000 by a comfortable but not overwhelming margin. With 0 hours of labor. With 0 risk of a tenant. With 0 chance of a leveraged wipeout in a recession. But the index fund only wins if you actually leave it alone. If you do not panic sell it in the next 33% crash. If you stay in your seat for 20 consecutive years, through 3 or 4 recessions, through every breathless headline telling you this time is different. And the house only wins if you can stomach negative cash flow for the first decade. The maintenance bills. The late-night phone calls, the eviction that costs you $7,000, the recession year where your equity drops to nothing on paper, and the 2,400 hours of your life you will never get back. Both paths work. Both have built fortunes. The difference is what you are willing to pay. And the only person who can answer that is the person watching this video. So look at the next 20 years of your life. Look at what you have. $50,000. Or 5,000, whatever the number is, and ask yourself one question. Are you the kind of person who can wait 20 years and do nothing? Or are you the kind of person who needs to feel the work in your hands? Because there is no wrong answer to that question. There is only an honest one. And once you have the honest one, the math gets very, very simple. But there is one more wrinkle in this story. Because the numbers we just ran assumed an average market. 20 smooth years. No catastrophe. The next video answers the question that breaks all of these assumptions. What happens to both Jake and Marcus when the market actually crashes? Not a little, but the kind of crash that takes a decade to recover from? The real math gets stranger than you think. And the answer surprises almost everyone.